Here is the enriched, high-value expansion of the provided content. 20. Credit management. Credit management in SAP SD is the digital enforcement of the cash is king philosophy. It is about protecting the business from bad debt while allowing sales to happen smoothly. It is one of the most politically sensitive areas in real projects because it sits at the intersection of conflicting KPIs, sales director wants zero friction, maximum revenue, and immediate order approvals. CFO wants zero risk, secured payments, and strict blocks on doubtful accounts. Management wants a system that arbitrates this conflict automatically. The polarity. When credit management is weak, sales grow temporarily the sugar high of revenue. But bad debts explode later, write-offs destroy the bottom line. When it is too strict, sales teams bypass SAP using manual invoices or cash sales workarounds, and business pressure mounts on IT to turn off the blocks. A senior SD consultant designs balanced, enforceable credit control. It is not about stopping sales. It is about stopping unprofitable sales. Simple credit limit check. The simple credit check is the basic form of credit control. It acts as a rudimentary on or off switch based on a single number. Characteristics: checks customer credit limit, looks at the value stored in the customer master FD32 or BP. Calculation: total receivables, open invoices, plus value of current order. Outcome: if receivables plus order greater than limit, the document is blocked. Used in small organizations, where the finance manager knows every customer personally. Low-risk environments, B2C scenarios, or cash-rich industries. Limitations: why senior consultants avoid it. No risk category. It treats a loyal 20-year customer the same as a brand new risky startup. No document type sensitivity. It blocks a sample order just as it blocks a standard order. No dynamic control. It does not consider future liabilities, open orders, efficiently. Senior insight: greater than simple credit check is rarely sufficient in real enterprises. It is a blunt instrument that causes more operational friction than it saves in risk. Automatic credit check. Automatic credit check is rule-based, scalable, and the industry standard. It changes the question from, is the limit exceeded, to, is this specific transaction risky for this specific customer? It allows different checks at different stages. You can warn at order creation, but hard block at delivery creation. Different rules per customer category. Gold customers get a warning, bronze customers get a block. Integration with delivery and goods issue, PGI. The check runs again before the truck leaves. Checks can happen at 1. Sales order creation stops the promise. 2. Delivery creation stops the logistics planning. 3. Goods issue, PGI, stops the physical loss of inventory. Why this matters? A customer might be fine when they place the order on Monday. By Friday, delivery time, their check might have bounced. Automatic checks catch this change in status. Define credit control area. The credit control area, CCA, is the highest organizational unit for credit management. It defines the scope of credit sovereignty. Function: it determines the currency in which credit is managed. Example: global limit in USD. It defines the organizational boundary for credit exposure calculation. It can cover one company code, decentralized credit management, multiple company codes, centralized credit management. Key design decision: greater than financial risk often crosses company boundaries. Greater than if a customer owes money to your French subsidiary, your German subsidiary should know about it. Therefore, a centralized credit control area, assigning multiple company codes to one CCA, is usually the best practice for global risk visibility. Assign credit control area to company code. This configuration step is the bridge between financial accounting, FI, and sales and distribution, SD. This links legal entity, company code, where the invoice is booked. Credit policy, credit control area, where the risk is measured. Configuration logic, transaction, OB38. It is a mandatory assignment. Even if you don't use credit checks, the system requires this link to process sales documents. Senior warning: greater than credit checks do not trigger at all without this assignment. If your sales orders are flying through without checks, this is the first place to look. Define risk category. Risk category is the segmentation engine. It classifies customers based on their financial health, allowing you to treat them differently. Inputs for classification: payment history, do they pay on time? Financial strength, credit rating agency reports, example, Dun & Bradstreet. Strategic importance, is this a key account we must indulge? Examples: 001, high risk, new customers, history of bounced checks. Rule, strict blocks, no open items allowed. 002, medium risk, standard business partners. Rule, standard dynamic check. 003, low risk or government agencies, multinationals. Rule, high limits, only warn, never block. Used to, apply different automatic credit control rules, EVA settings, to different customers within the same credit control area. Define credit groups. Credit groups differentiate the stage of the process where the check is occurring. They allow granular control over when to stop the process. Definition: Group 01, sales order. Group 02, delivery. Group 03, goods issue. Why is this powerful? It allows for soft order, hard delivery logic, at order. Group 01. Configure as a warning. Let the sales representative take the order so they can capture the demand. At delivery. Group 02. Configure as an error. Stop the warehouse from working on it until finance approves. Senior insight. Greater than this prevents the sales prevention complaint. Sales can do their job. Enter orders. But operations is protected, no shipment. Assign sales documents and delivery documents. This step links the specific business process, document type, to the trigger point, credit group. Configuration, sales document types, OVAK. Assign order type OR to credit group, O1. Note, you would not assign credit groups to order type RE, returns, or KB, consignment fill-up, if they don't carry credit risk. Delivery types, OVAD. Assign delivery type LF to credit group O2 and goods issue credit group O3. This determines when does the check happen at order, delivery, or both. Behavior. What happens if the check fails? Common setup, OR, standard order. Check credit, O1. FD, free of charge. Do not check credit, leave blank. Define automatic credit control. This is the heart of the configuration, transaction EVA. It combines the credit control area plus risk category plus credit group to define the specific behavior. It defines which checks apply: static, dynamic, max stock value. Reaction, warning, A, error, B, or ignore. Status update, does it set a block on the header, VBUK? Types of checks, the menu of risk. 1. Static credit limit, total open items plus open orders. Simple but effective. 2. Dynamic credit limit, static limit, but ignores open orders scheduled for the far future, beyond the horizon. Ideal for seasonal businesses booking orders 6 months in advance. 3. Oldest open item, blocks the customer if any invoice is overdue by X days, even if their total limit is not exceeded. This forces discipline. 4. Maximum document value. We don't trust this customer with any single order greater than $10,000. Senior insight. Greater than, this is where business risk appetite is encoded. The oldest open item check is the most aggressive weapon in SD. It freezes new sales until old bills are paid. Changes in item category. Not all line items in a sales order carry financial risk. Item category configuration determines relevance. Controls, transaction VOV7, credit active, checkbox. Examples, TAN, standard item. Credit active equals yes. TAN, free goods. Credit active equals NO, no receivables generated. KEN, consignment issue. Credit active equals yes. KB, consignment fill-up. Credit active equals NO, stock still belongs to us. Wrong setting causes greater than credit blocked unnecessarily if free goods or packaging materials consume the credit limit. Greater than credit risk hidden if a high-value item category is accidentally flagged as non-relevant. Changes in pricing procedure. Pricing procedure controls which value is sent to the credit check. Mechanism. Subtotal A. In the pricing procedure, V or O8. Assign subtotal A to the specific line, usually the net value or gross value. This prompts the system to update the credit table, S066 or S067, with that specific value. Crucial decision, net value versus gross value. Do we check credit against the net price, revenue, or the gross price, revenue plus tax? Answer, usually gross value. If the customer defaults, they default on the tax amount too, which the company has already remitted to the government. You must protect the total collectible amount. Senior insight, greater than credit exposure should reflect the real cash impact. Checking only net value exposes the company to tax loss in jurisdictions with high VAT or GST. Example: 20% plus, division-wise credit limit. Division-wise credit limit allows for compartmentalized risk. Concept: a customer might be a good payer for consumer electronics, Division 01, but a terrible payer for industrial machinery, Division 02. Configuration: allows separate credit limits per division for the same customer. Used in large conglomerates, where divisions operate as separate business units, SBUs, with their own P&Ls. Risk: over complexity. Managing one limit is hard. Managing 5 limits per customer is a nightmare for the credit department. Data maintenance: requires constant updates. Rule: greater than use only when the business units are strictly financially independent. Otherwise, a consolidated limit is safer. User exit for credit management. Standard SAP credit checks are rigid. User exits allow custom risk logic. Key exits, LVKMP001 or LVKMP002 or LVKMP003, allow you to write ABAP code to bypass or enforce checks based on complex logic. Examples of custom logic: grace period. Don't block the order if the oldest open item is $10. Ignoring small change. Strategic override. Never block customer X during the last week of the quarter to hit sales targets. Letter of credit. Check against the letter of credit value, not the standard limit. Senior rule. Greater than use exits only as a last resort. Hard-coded credit logic is difficult to audit and difficult to change when company policy evolves. Real project credit scenarios. These scenarios show how configuration translates to business reality. Scenario 1. New customer. The short leash. Risk category: high, 001. Check. Dynamic plus max doc value. Limit: low, $5,000. Result: the customer can buy small amounts. If they pay, the limit is manually increased. If they try a massive order, it blocks immediately. Scenario 2. Strategic customer. The VIP. Risk category: low, 003. Check. Static check, warning only. Limit: very high, $1M. Result: the sales manager gets a warning if they exceed the limit, but the order is never blocked. Shipment is guaranteed. Scenario 3. Chronic defaulter, the bad actor. Risk category: critical, 004. Check. Oldest open item. Logic: if any invoice is overdue by greater than 1 day. Result: total shutdown. They cannot buy a single screw until they clear their past due invoices. This turns the sales rep into a debt collector. Common, real project failures. 1. Credit check. Not triggering, usually missing assignment of company code to credit control area or sales order type not assigned to credit group. 2. Orders blocked unnecessarily. Open orders, S066, were not rebuilt. Ghost orders from years ago are consuming the credit limit. Fix, run RVK RED 77. 3. Credit exposure calculated wrongly, pricing subtotal A assigned to the wrong row, example, excluding tax. 4. Sales bypassing SAP, creating cash sales or pro forma orders to ship goods without hitting credit checks. 5. Manual overrides without audit. A credit manager releasing orders via VKM3 without adding a reason code or comment. Root cause: greater than poor alignment between SD, FI, and business policy. The system is configured for a policy that doesn't exist or isn't enforced. How senior consultants design credit management. 1. Understand real payment behavior. Do not ask what is the policy. Ask how do customers actually pay. 2. Segment customers by risk. Force the business to categorize their customers. One size fits nobody. 3. Apply staged controls. Use warning at order and error at delivery. This balances sales speed with finance security. 4. Minimize manual overrides. If 50% of orders are blocked and manually released, the credit limits are wrong. Fix the data, don't rely on the release. VKM3 process. 5. Ensure audit visibility. Every release must be logged. Who released it? When? Why? Mental model to lock in. Credit management answers. Greater than, how much risk can we afford right now? It is not anti-sales. It is pro-business survival. Think of credit management as the brakes on a sports car. The brakes don't exist to make the car go slow, they exist to allow the car to go fast safely. Without brakes, you cannot race. Final perspective, credit management is the guardian of the company's valuation. Cash flow ensures money comes in. Profitability prevents bad debt write-offs. Business continuity ensures we have funds to buy raw materials for the next order. Loose credit control kills companies slowly, bleeding cash. Overly strict credit control kills growth, suffocating sales. Senior SD consultants design balanced systems that, greater than enable sales, flow, greater than, while protecting the balance sheet. Fortress. Say next when ready.